Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to do a state of the market update. I'm going to go through the index charts, a couple of breadth indicators, get a gauge of where we are. Before I start, quick announcement. We're doing our annual Cyber Week special. Buy an annual membership, get 3 months free. Comes out to be less than $50 a month. For all that, you get all of our trading ideas posted in chart form with comments. Daily and weekly reports where we talk about our analysis, what's going on in the market, breadth readings, etc. Trends, how strong are the trends and such, and our message board. We've got a lot of members here who have been subscribers for 5, 10, 15 years who post a lot of really valuable information. Some people are members only because of the message board. So anyways, check it out. To subscribe, just go to our homepage here, click subscribe, follow the steps, sign up for an annual membership, and then we will add on the extra couple months. All right, let's get into it here. All right, so first we're going to go through the S&P index charts, and then we'll get into some breadth. All right, so here is the S&P monthly going back 5 years. I view this mostly as a big consolidation pattern. Okay, for more than 3 years, the index has sat in this range between like 3,600, 4,800. The current middle, or close to the middle, is 4,200, which has acted as support and resistance. A key level here has also been the 10-month moving average. It's the line you see here. It's acting very orderly. Okay, the market has rallied up a lot. You can go back prior to where this chart starts. We've had a big rally in place, and now we have basically a 3-year consolidation pattern. That's not so bad. So currently looking at where we are, it looks like 4,600 is a key level or thereabouts, maybe a little bit above 4,600. There's a range here. And if that level can get taken out, then for sure we're going to go up to 4,800, the all-time high. Okay, so for right now, I consider the market to be acting well. Okay, everything it gained in 2021, it lost in 2022. Okay, now we're on the way back. We broke out here at 4,200, came back and tested that level plus the 10-month moving average, and now we're moving up again. Overall, the market's acting fairly well. It's not like amazing, okay, because again, we're in a 3-year consolidation pattern. But that kind of tells you the fact that we're in a 3-year consolidation pattern actually is more bullish than you think, because a lot of people look at the current market and say, well, it's rallied so much, how much more can it possibly go? But when you back up and look at the bigger picture and realize that like everything that has happened since bottoming last year has taken place within a range, and we can start measuring up where like we have like big move here, consolidation pattern for 3 years, and then what if we get a big move up from that? Okay, so even though the market's gone up a lot, if we break out of this range, there's huge upside potential. Here is the weekly chart going back a couple years. We have a large cup and handle pattern that is forming. This has very bullish implications. It's potentially bullish. I mean, it is bullish, but it's only potential, and there's no guarantee it's going to break out to the upside. It just kind of sets the stage that there is a potential big move coming. Okay, if we, maybe we need another dip over here. I don't know. Maybe we consolidate here below the neckline. I don't know. But if we can get up here with a little bit of volume and we can hold the gain, we're still going to have the overall overall high to deal with. But if we can break out there, every single index trader who's been sitting in the S&P 500, who's bought it over the prior 2 years, is going to be sitting on a profit. And people who are sitting on profit tend to just be happy and keep them. Okay, so this is potentially bullish. It sets the stage for the possibility of a big move coming if we can break out and get some follow through. And it's certainly much more bullish than it is bearish. And I want to make another point here is that you can't wait until the index breaks out and gets up here, but because by the time it does that, the index will have already moved a lot. Okay, at Levitt Brothers, our bias has been to the upside. Okay, for the last several weeks for sure, and so that's been our bias. And one of the reasons why, besides the fact that there's been a lot of great trades to be had, and you got to take advantage of those, is that if you have the attitude that I'm going to wait until the index breaks out to a new high to get long, what happens is the index will have just gone from 4,100 up to here, like 46, 47, 4,800. And you're going to sit there and say, well, I can't buy now. It's up so much. So you can't wait until it breaks out to be active in the market. The market's acting well. You got to be long. If it breaks out, bonus, you're going to add to positions. You're going to take on new positions. If it doesn't break out, then you just play good defense with the positions you have. All right. Here is, for the sake of completeness, here's the daily chart. You can see did really well first half of 2023 here. Then we had this series of lower highs, lower lows. A lot of people were looking at this pattern here where we had a neckline here. Actually, let me delete those. We had a neckline there, kind of a hump here, bigger hump, smaller hump. A lot of people were looking at this saying a head and shoulder top, broke down, came up, got rejected by the 50-day moving average, and then dropped again. Perfectly reasonable to be bearish while this was playing out. Lower highs, lower lows, longs weren't working that well, shorts were. Perfectly reasonable to be bearish as this thing is falling, especially down at the lows. But when it starts to go up and there's some oomph behind it, you got to change your stance, okay? It's a hallmark characteristic of a successful trader is that you can have an opinion one day, and when something happens in the market that should force you to change your opinion, instead of digging in and defending that opinion, you change. Okay, simple as that. You can have an opinion, that's fine, but when something happens, you change. So if you're bearish over here at the end of October, that's perfectly fine, perfectly reasonable if you're positioned short. But as soon as the market starts going up and there's like volume behind it, and we're getting like each day the market gaps up and runs higher, you got to change your stance. You got to recognize that something has changed. All right, so big move down, complete recovery. Now we just have, the high from over the summer to deal with, and then we can start pecking away at the all-time high. But it's a really nice recovery, volume behind it. It'd be nice if we got a dip here, but who knows? The market doesn't seem to want to do that. All right, let's go to some breadth readings. Okay, short term, there are a couple of warnings, not major warnings, but just a couple of warnings. So here's the S&P 500 up top, the 5-day moving average of the NYSE AD line down below. So as you can see here, S&P 500 pushing higher, but the AD line is putting in lower highs. Okay, the market doesn't have to crash. Okay, over here we had a divergence, as you can see, and you can see the market actually did top here and move down. Divergence formed here, and the market moved sideways for a bunch of weeks. Divergence formed over here at the beginning of the year, and the market corrected and then recovered. So the market could top and fall a lot. It could trade sideways. It could drop moderately. Something's going to happen here, okay? Like unless this gets negated, unless this indicator breaks out here and gets negated, we're going to, at some point in time here, we're going to have a little bit of a pullback, okay? So just be prepared for that. Be mentally prepared for that. Don't throw all caution to the wind here and chase stocks higher. A little bit of a warning here. Another look at the advanced decline line. This is the advanced decline. This is the cumulative advanced decline line. It matches up very closely with the market. Okay, so you have like a high here and a high here and a low here and a low here. You have a high here and a high here. And notice right here we tried to match that high, but the lower high was put in place. So what happened? The market corrected here. Okay, we got a high here and a high here, low here, low here. Okay, over here we got this trended down. So what did the market do? This trended sideways to wait for the AD line to improve. And it goes on and it goes on over and over like this. Okay, they're very closely matched up. So when they stop correlating with each other, you got to take note. So the bigger picture here says the S&P dipped and recovered and is now at a higher high, while the AD line dipped and is in recovery mode, but it's it's well below that high. So a little bit of a lack of confirmation here. Looking back a couple months, something to keep in mind. We've had a good run here, volumes behind it, a lot of great trades to be had. Don't get too lazy with your management. All right, next up is the S&P 500 up top versus the NYSE AD volume line. Okay, not the AD line, but the AD volume line. We're getting the same divergence that's forming. You can pause the video if you want to look at it closely. I don't want to talk too much about it because it's pretty obvious what's going on here. S&P 500 pressing higher, higher highs, higher lows, and we have a lack of confirmation here because this indicator is falling, has been putting in lower highs. Okay, in the past, same thing. We have a divergence like over here. Okay, and the S&P just moved sideways. We've had other divergences like right here where it didn't confirm, and this moved sideways and moved down, moved up, and then moved sideways. So essentially, we got a couple weeks of sideways motion. So lack of confirmation on the way up tells us probably going to have some weakness at some point in time. We don't want to get too carried away chasing stocks higher. All right, a couple more here. We have, this is the S&P 500 up top versus the 1 month highs. Okay, market moves up, you expect new highs to do the same. To highlight what's happened in the past, we got market moving up here, higher highs, higher lows, lack of new highs falling off, so confirmation is not there. And what happens? The market tops and falls. Same thing happened over here. Market's moving up, new highs falling off. What do we get? We got sideways motion, sideways movement for a couple weeks. We're getting the same thing here. Market's pressing higher, but there's a lack of new highs. Okay, they've been falling off, so it tells you that not everything is on board. And we're probably going to get some sort of either sideways movement for a little bit or a correction is probably in the works unless this indicator quickly gets negated. Here is the S&P 500 up top versus Russell 3000 stocks above their 20-day moving average, currently sitting at a nice level. Okay, I don't expect it. Once it gets up to about 80%, I don't expect it to expand more than that. It's just not going to happen. There's always going to be some weak stocks that don't participate. So this is a really good level. Confirmation, good. Okay, no major warnings there. Okay, a couple other bonus charts just to throw these in. Rates, which are obviously important, have dropped from 5% down to 4.35%. So that's helped the market recently. Here's the SP versus the US dollar. Most of the time, the dollar and the SP have moved opposite each other. So the fact that the dollar has dropped so much here has helped the S&P. Okay, so that's another nice development. Okay, so that's all we got here. Overall, market's in good shape. The weekly charts are formed. The weekly chart is forming like a potentially very bullish head and shoulders pattern. 2024 could be a great year if we can break out of that pattern and keep going. In the very near term, couple warnings, okay? Number of stocks trading at new highs have declined, or new 1 month highs have declined. AD line lagging a little bit, AD volume line lagging a little bit. So overall, I like the market. We're starting to get a couple of warnings in the near term. Shouldn't be any big deal. It'd be fantastic if the market could just move sideways for a couple weeks and then break out and then follow through into 2024, and the stage is set for 2024 to be a big year if the cup and handle pattern can break out to the upside. All right, that's all I have. Check out our special right now. Buy an annual membership, get 3 months free. It's only it's less than $50 a month for all our trading ideas, all our analysis, our message board and stuff. All right, we'll see you next time.